Well, let me be clear. There is a difference between the macroeconomic outlook and the market outlook. And that's because we have felt for a long time that we'll achieve soft landings across most economies over the course of this year, and that inflation is coming down relatively quickly. All of that is very good news. That being said, we're a little bit more cautious on markets because that prospect is very much priced. Now, we are seeing marginal improvements still coming through, and the earnings seasons have been, on balance, a little bit better than many people feared. But there's not enough earnings growth really to push markets significantly higher from here. So we're not negative. We don't see a lot of downside. But I think, to be fair, we don't see a lot of upside either. And that's not just for equities, but for bonds and credit too. We believe that markets are pricing interest rate cuts too quickly now. And there's a risk that people will be disappointed by rates staying higher for longer. And with valuations in equities, particularly the US, still being pretty high, there's not a lot of upside. So we're looking at really differences across markets and within markets as the main opportunities for investors.
And I hear everything you're saying, Peter. And just to pick up on your last point, 21 times in the US does not provide a very appetizing platform to get into, for instance, your average S&P stock. And yet, if that were to come off and we were to see declines in US markets based on the fact that valuations aren't supportive as well, we would see it in Europe as well, albeit maybe at a lesser degree because we have valuation support. So even though the European market looks cheaper in terms of equities, it still potentially is at the vagaries and at the, I guess, the vicissitudes of what the fortunes are for the US market.
Yeah. Very much so, yeah. I mean, historically, any time the US market has had a correction of 10% or more, markets become very correlated on the downside. So whatever the relative merits of Asia and Europe, and we've been overweight of those for some time and consider that there's still better relative opportunities. And if we were to see a meaningful correction in the US, then I think we would see that across all geographies. That being said, we're looking at zero profit growth for the S&P for this year, 5% for next year. With the valuation base that you mentioned, we see the US being pretty flat this year. And we've got Asian markets up, in the low teens to mid-teens, and Europe up around 6% from here through to the end of the year. So we still see better performance outside of the US, based on a central assumption that the US index is relatively flat. There are lots of opportunities within markets, both in the US and elsewhere, but I think investors have really got to look beyond the index level and certainly at more diversification geographically than they've been used to, I think.